Hello and welcome to Lipper's Fund Flows Insight Report. I'm Jeff Tjornehoj. For the week ended January 2nd, 2013, the conventional mutual funds industry, exclusive of exchange-traded funds, saw inflows to money market funds exceed over $30 billion, while the rest of the industry was fairly flat. Let's take a look at our macro groups and see where the activity was. Starting off, we saw that equity funds continued to suffer outflows this week, about $3.5 billion. Taxable bond fund investors took a real break. They only allocated about $800 million in net new money to their coffers. Municipal debt funds had next to zero in flows activity, while money market funds, again, had about $37.8 billion flow into them. Now, despite a pretty good week in the markets, which saw equity funds on average up about 2.9%, investors really couldn't follow through on that performance with more money. Instead, as I said, they withdrew about $3.5 billion. The pain was spread about pretty evenly throughout the equity funds group. We saw a fairly strong negative sentiment in a lot of areas. Domestic bond funds or domestic equity funds had about $3.6 billion in outflows, so they accounted for the lion's share of outflow activity. Overall, if we look back over the entire year, this was the 7th consecutive year that domestic equity funds, mutual funds, have had outflows. About $94 billion this year. We're waiting for some last-minute data to arrive, but it'll certainly be at or near last year's $94 billion, so roughly tied for second in the history of mutual funds. Again, 7 years of outflows doesn't seem to be changing anytime soon, so look forward to 2013 being another year with more weeks of outflows from equity funds than inflows. At the same time, non-domestic funds only took in about $2 billion total this year on a net basis for 2012. So there's not exactly a silver lining out there for equity fund groups. It's not just the domestics, the non-domestics just aren't attracting a lot of attention either. The next group to take a look at, a subset, is the equity ETFs. This group did have a little bit of inflow activity this week, about $2.7 billion. Of course, these investors react to good market moves much more quickly than mutual fund investors do. Most of the activity was through SPY, the S&P 500 ETF. It took in about $3.8 billion. We saw more inflow activity into the broad market groups like the Russell 2000 here, while sector funds, sector ETFs, saw more outflow pressure. We saw that the select sector group, 7 out of the 9 sectors had outflows, and as you can see in the bottom of this page, that 3 of the largest outflows were from that series. So overall, investors were more interested in just getting a broad exposure to start the new year and were less committed to individual sectors. Well, certainly things will change over the course of the year, but to start off, I think everyone is just trying to get their footing right before they start shifting and pivoting. The next group to take a look at is taxable bond funds. Again, they had very light inflow activity, about $800 million this week. There might have been some tax selling going on here. We'll touch on that a bit later. Mostly just reflected some uncertainty. Perhaps fiscal cliff negotiations were causing people to take the foot off the gas pedal when it comes to bond funds. Certainly a lot of commentary was made in the closing moments of 2012 that equities were poised for a comeback and that the taxable bond bubble might burst at any time. I certainly don't share those views. I think it'll be another solid year for taxable bond funds in 2013, although putting up numbers like this past year are unlikely, but still respectable. Overall, we saw high yield also take it on the chin this week. They had their 3rd consecutive week of outflows. So it's not as if people are abandoning all taxable bond funds. It's really high yield, some of the more riskier areas that are facing the most selling pressure these days. When it comes to fixed income ETFs, we saw another good week for them. They had about $400 million in outflows, which doesn't sound good, but it's an improvement over the last couple of weeks where they've suffered their 3rd consecutive week of outflows. So very light, no pattern here that I could detect among the various strategies where inflows and outflows varied. It seemed to be a very opportunistic and very dependent on the individual investor. So the next group to take a look at is municipal debt funds. Let's touch on tax selling. We saw some outflows. They had 3 weeks of outflows to finish the year. Again, I think with such a strong year in performance terms for municipal debt funds, it was not surprising to see some selling at the end of the year. Some investors more sensitive to these issues, and this is traditionally the time when these issues take place. You'll notice in the closed-end community, this is probably even more prevalent. So overall, this week, I called the outflows flat, zero, even though it was about $6 million that we estimated. Given the size of the industry, that is probably within the error term. So we're calling it flat for flows this week. The last group to take a look at is money market funds. Again, with about $37.8 billion. It looked to me like there was a lot of cash being parked this week. Probably a good place to end the year and start the year with some dry powder. Retail investors and institutional investors alike took advantage of the opportunity. Retail investors parking about $16 billion and institutional a little bit more, close to $23 billion there. So overall, looked like some investors were just getting ready to make some moves at the start of the year. Wanted to be ready for any new movements to take advantage of. Well, that'll do it for this week. Please join us again next week. We'll take a look at flows within mutual funds as well as exchange-traded funds. Thanks for joining us, and we'll see you again next week.